Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Alix Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence show, we dig inside the big stories impacting Wall Street and the global markets. Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide. Today, we'll look ahead to some of the global themes for markets in 2025. Plus, we'll discuss how global asset managers may fare this year. But first, we dive into healthcare. Bloomberg Intelligence recently put out its 2025 Healthcare Tech Outlook, and the research shows that drug distributors continue to shine in 2025 as pharmacies still show signs of weakness. For more on this, co-host Alix Steele and I were joined by Jonathan Palmer, Bloomberg Intelligence Senior Healthcare Analyst. We first asked Jonathan what he thinks some of the bright spots are in the healthcare sector.
There's a couple. So it's healthcare technology and distribution that includes a whole host of companies, everything from CVS and Walgreens to the drug distributors and then to all the healthcare technology names. And so there's some really idiosyncratic themes at work here. Pharmacies, the news is not so good. Distributors, it's very positive. In the world of tech, again, because these are all very idiosyncratic business models focusing on different things, there's pockets of very good, pockets of okay, pockets of not so great. My key themes are around the drug distributors and pharmacy. The drug distributors are doing very well. They've got great underlying fundamentals. There's more people taking more drugs. They've been utilizing their capital to buy what they call MSOs, which are management service organizations. Not to get too deep in the weeds, but these are companies that manage practices of like oncologists or other specialists. And really, that helps diversify their income stream and not make them, totally captive to the trends in underlying drugs consumption. So that's been a great trend for these guys. It's diversified them, and it's got a long shelf life here too.
Did the elections and the election of President-elect Trump and the Republican control of Congress, how's that going to impact healthcare? What's the feeling out there?
Yeah, so I think it's a wait and see. The President-elect Trump did not campaign on many healthcare issues, although obviously there's stuff swirling in the background. What we saw out of the last administration was some ideas around limiting PBMs. That never came to pass. There's a thought that maybe that will come back in this administration.
So these are pharmacy benefit managers.
These are pharmacy benefit managers. The big three are CVS Caremark, Express Scripts, which is owned by Cigna, and then United Healthcare. They own Optum Rx. And so actually in December, Senators Warren and Hawley introduced a bipartisan bill where they would ban these PBMs or managed care companies from owning pharmacies. We don't think there's very much chance of that bill passing, but it still points to kind of the rhetoric and saber rattling coming around out of Washington around some of these healthcare models.
So does that just mean a harder year for CVS, Cigna, and United Health, even if that kind of split doesn't happen?
Yeah, I think it's pretty unlikely that split comes to pass. But I think it points to the anger that a lot of people have, in the marketplace around healthcare and who they have to deal with.
Talk to us about the drug distribution business. Why do you like that business, and what are the names that?
Sure. So there's three big companies. What used to be called AmerisourceBergen, but it's now called Cencora. Cardinal Health and McKesson. I mean, these are really great fundamental businesses. They control 90% of the U.S. drug distribution. It's not just logistics. I think it's simplistic to think of that way, that they just get the drugs and they take them from the manufacturer's warehouse to the local pharmacy. They've built a whole host of these service businesses around all of that. And that's where the future of those businesses really is.
Well, what does that mean? So why isn't it just the logistics? So paint us a bigger picture.
Yeah, so I talked about it before, those MSO businesses. McKesson owns what they call U.S. Oncology, which is this massive network of oncologists. It's about 20% of the community oncologists in the country. And so that's really like a captive captive portal of business. There's all those oncologists order through McKesson. McKesson manages their EHR. They manage the billing. So it's actually really branching out outside of the pure logistics piece.
So healthcare, I'm looking at the S&P 500 up 23% last year. S&P healthcare sector kind of flattish. So what's the investment backdrop for just healthcare right now?
Yeah, I think it depends where you're looking. I mean, I don't focus in therapeutics, so I'm probably not the best person to ask about the biotech world or pharma. But outside of that, we've seen a lot of pain in the managed care world around Medicare. Most of those companies, particularly CVS in particular, have suffered because out of the pandemic, we've seen a lot of utilization of care that's caused margins to collapse in Medicare Advantage, and that's one of the big growth areas in the managed care world. So managed care is a little bit of a slog right now. Outside of that, in let's say like life science technology, those companies have been dealing with poor demand from pharma and trouble in China. China hasn't been the best market for them for a while. And then on the more like, let's say, service side or technology side, I think it depends on where you play. DTC models were very popular, things like telemedicine and virtual care during the pandemic. Those have come back. But some of the survivors, the Hims and Rose, which is a private company, are seeing a lot of uptake around GLP-1 drugs. And so it's a little bit hit or miss depending on where you're playing.
What do you think the GLP-1 drug forecast is for this year?
High.
But will insurers finally cover it?
Well, I think that's the big debate. I mean, around who's going to pay for what, and it's happening on the commercial side. Employers. It's happening in Medicare and Medicaid. The demand is clearly there. It's just what can people afford to pay, and so there's a whole host of business models that have kind of arisen around. Not circumventing, but working outside of the pure insurance. These are the things like Hims, which I just mentioned, where if you just want to pay out of pocket, you're going to get yourself a GLP-1.
There was a whole compound thing, right? Wasn't there a compound one that you can have that's a lot cheaper?
That's the Hims and Hers and all that kind of. That's where you see, I think, all the ads around.
Yeah.
So when drugs are in shortage, which many of these GLP-1 drugs were, the compound pharmacies can meet that demand by using kind of generic compounded drugs.
Is AI in your space at all?
It's everywhere.
I'm sure your research director said, write a research report on how AI is impacting your industry.
You have to have it so you can search it and find it. Yeah. Mm-hmm.
It's everywhere. I mean, my view is that there's probably going to be a handful of killer apps, things around voice and ambient listening. We've seen some of that. Microsoft bought a company called Nuance a few years back. I'm sure there's others. A lot of it, I think, is going to be table stakes, particularly for the stuff that's back office, for payment processing, claims adjudication. Everybody's going to do that. So it's definitely top of mind for most management teams here.
Our thanks to Jonathan Palmer, Bloomberg Intelligence Senior Healthcare Analyst. We turn now to the oil and gas industry. This week, President Biden announced he'll block 625 million acres of ocean from offshore oil and gas drilling. He cited environmental and health risk. For more, co-host Alix and I were joined by Simon Casey, Bloomberg Managing Editor for Energy and Commodities. We first asked Simon if Biden's actions will hurt oil production.
Offshore oil accounts for, I think, 14% of U.S. output, which is something, but it's not everything. And most of that U.S. oil output, I think, as we all know, comes from shale. Shale production grew substantially last year. It's probably slowing a bit, but that's where the industry has really grown enormously over the past decade and probably will continue to grow for a few years to come. It could slow this year, as I say, but there's huge amounts of resources still on land.
So is this something that President-elect Trump, when he is sworn in, he can just turn this around with another executive action?
He can try. But I think it was back in the beginning of 2017, there was a similar ban put in place, not on such a grand scale by Obama. But Trump came in, he made an order to reverse that decision, and it was stopped, I think, in the Supreme Court in Alaska, I think I'm right in saying. It didn't go beyond that. So there's no legal precedent for an incoming president to overturn an order such as this one.
And the argument that it would hurt oil and gas offshore, even though it's only 14%, a large portion that comes on the Gulf of Mexico. Is the Gulf of Mexico included in the 625 miles?
Yes, it is.
How much of it is in that versus, say, the East Coast or around Florida, for example?
I don't have the numbers right in front of me. I mean, look, the Gulf of Mexico is an important component of U.S. oil production. It's also, we should note, it's low cost, it's relatively stable. But I mean, this is a very clear move by Biden to appease the environmental lobby, the left wing of his base. If you cast your mind back to the beginning of the Biden presidency, he came in on quite a sort of a progressive energy agenda. He was trying to clamp down on oil production. He was very emphasizing a great deal his priority to tackle climate change. What's happened in the years since then? Of course, we had spikes in energy prices. We had the war in Ukraine. Energy security came to the fore. So, in a way, this is sort of his parting gift, if you like, to that part of the environmental lobby and to his supporters who wanted to see him all along try and clamp down on the oil industry to some extent.
All right, so the deep water issue that happened in the Gulf, I guess that's kind of a worst case scenario for this offshore. I guess just trying to get a sense of the risk reward here, and get away from the politics a little bit. And it seems like with fracking, maybe you don't need it as much, but at some point you might need it.
So let's just have context here. So Paul's watching Landman.
Yes, I'm watching.
So now
Landman.
he's a complete shale expert.
Okay.
But now we're talking offshore, and now it's TBD.
I don't know, yeah.
This is just the context here.
Yeah, like Deepwater Horizon, worst case scenario.
Saw that movie.
But I mean, when that kind of thing happens, maybe once in a decade, once every 3 decades, it's a catastrophe, as we all saw, we all remember. There are risks anywhere you drill, to be sure. There are huge environmental issues onshore, and we shouldn't sort of downplay those either. Biden, in his announcement this morning, made clear this is, it's in relation to environmental risks. He also cited climate. He also cited the risks to communities onshore. Let's not forget the infrastructure, the industries. While they do provide a huge economic stimulus somewhere like on the Gulf Coast, they're also daily sort of environmental reminders, small oil leaks, the kind of things we don't always report on, frankly, but they do have a cumulative impact. The impact on wildlife, on bird life. Let's not forget as well that President Trump, when in his first term, he tried to clamp down on drilling offshore off the coast of Florida.
Our thanks to Simon Casey, Bloomberg Managing Editor for Energy and Commodities. Coming up, we'll break down how the energy sector may fare under an incoming Trump administration. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We move now to some of the key market themes Bloomberg Intelligence is focusing on in 2025, mainly from a European and global perspective. This week, co-host Alix and I were joined by Tim Craighead, Bloomberg Intelligence Global Chief Content Officer. He discussed everything from earnings season to how a Donald Trump presidency will impact the globe in terms of tariffs. We first asked him to break down his recent research.
We're actually seeing some positive revisions to earnings in Europe and in particular in the UK, which actually flies in the face of an awful lot of other markets, including elements of the US market, heading into year-end earnings where we're starting to see some negative revisions. Actually, it started back, a few months ago. So that element of it's cheap, do you jump in because that's an old argument. But if there's an earnings catalyst behind it, it gets interesting.
What about tariffs? How are we thinking about tariffs from the U.S. on all the things?
Yeah, well, I think our economists are pretty smart arguing that tariffs are more of a 2026 thing than 25. It's more of a posturing element for this year in front of working out negotiations. He's, the art of the deal. He loves negotiating, and so, that's how tariffs will be used specifically from a European perspective. frankly, it's a lot less of an issue than you might guess. An awful lot of what Europe sells to the U.S. is either services or it's stuff that's already manufactured over here. It was an interesting interview with Unilever, and one of the queries that Francine Lacroix had asked him is, isn't this really bad for you, because you're a European consumer product company? It's like, no, we're a U.S. consumer product company. We manufacture in the U.S. with U.S. brands. We happen to be headquartered in London, but I don't think it's that big of a deal, frankly, except in targeted specific areas that you have to watch out for. Maybe that's autos.
It's interesting here in the U.S. since the election, there's been a palpable sense of optimism from the business community, thinking that this administration would be pro-business, pro-growth, and that is argued as one of the drivers of the stock market performance we've seen since kind of August, September, when it became clear that former President Trump might in fact win this thing. Yep. And is that what you're hearing from your European clients? How are your European clients thinking about the change we're going to have here? I actually heard some Europeans were putting more and more money into the U.S. markets over the last few months.
Yeah, I would totally agree with your conclusion. There's obviously lots of room to discuss and debate on the political side of things, whether you like it or you don't like it. Set all that aside, the idea that you're going to cut regulation and you're going to cut taxes, and maybe you're going to do things on immigration and tariffs, but that's to come. That's not going to impact this year's earnings trends. And so, I think it's a positive when you think about it from a business and economic perspective. For the moment, it's more of the earnings impetus that's good, and the inflation worry gets sort of pushed out a little bit. And European companies they do so much business back and forth with, again, a lot of it being domesticated. That's a good thing.
What about the tariff risks when it comes to China? Because if China gets hit hard, doesn't that wind up feeding into Europe, particularly when it comes to, say, luxury goods and cars?
Well, I would agree with you to a degree. Frankly, if the whole tariff thing really goes heavy and there's lots of retaliation, the Bloomberg Economist had done a really interesting piece, you guys will recall, that basically shows the biggest hit is Mexico. The second biggest hit is the U.S. China has already curtailed so much of what they sell here, other than certain products. It's less of an issue for the Chinese economy, and it'll end up, importantly, re-globalizing connections and supply chains. It could end up being good for Europe in a weird way, because they're now a big developed market participant, with the U.S. going more insular.
Our thanks to Tim Craighead, Bloomberg Intelligence Global Content Officer. We now turn to the energy space. As Inauguration Day approaches, the energy sector looks for signs of what to expect when President-elect Donald Trump takes office. For more, co-host Alix Steele and I were joined by Mike Sommers, President and CEO of the American Petroleum Institute. We first asked Mike what day one under Trump administration will look like for the energy sector.
Well, we've laid out an API 5-point policy roadmap. You can find it at api.org of the things that we're asking this president and this Congress to do during the first 6 months of the administration. But there are some things that they can get done early in the administration, really on day one. So one of those things is lifting the LNG export pause. We're excited that we have a new president that's focused on that, and he's committed to lifting it on day one. So that's one thing we think that they can get done very quickly. The second thing that we think they can do is they can authorize a new 5-year leasing plan in the offshore Gulf of Mexico. We need a 5-year leasing plan that prioritizes new leases in the Gulf of Mexico, which continues to be a prolific region for the American oil and gas industry. About 14% of American oil comes from the Gulf of Mexico, which is why what President Biden did in setting aside new acreage that we will not be able to develop was so concerning and so disappointing. Another big thing that we're focused on is repealing the EPA tailpipe mandate, the EV mandate that they put in place early in the Biden administration, and we'll work with the Trump administration to get that repealed and replace the CAFE standards that are draconian and U.S. automakers can't meet. So those are 3 of the key priorities that we want to focus on early in the administration. And then in addition to that, we need to get a new tax bill in place before the end of 2025. We're prioritizing things like the corporate tax rate, of course, And then really focusing on how we continue to build American geopolitical strength by expanding energy trade throughout the world.
Green energy, how does green energy work with traditional energy? I'm not sure what the preferred term is for oil and gas, but how does green energy work with oil and gas and traditional energy sources?
Well, the truth of the matter is that we know that we're going to need all sorts of energy to meet the energy needs of the future. If Goldman Sachs is right, and we're going to need 10% more energy for the next 10 years to support data centers and AI growth, we're going to need all sources of new energy, which is why it's important that we get a new permitting bill in place so that we can build out not just oil and gas pipelines, but new transmission lines for those new energy sources as well. The great thing about natural gas in particular is that it can support these alternative energy sources as well, because we know that the wind isn't always blowing and the sun isn't always shining. You're going to need something to back that up, and natural gas is almost always the preferred energy of choice when backing up those sources. So we know that we're going to need more energy. We don't just need all of the above, but more of all if we're going to be successful in leading the future, particularly when it comes to AI. So we want to work with our partners in the other energy system to make sure that we can continue to expand.
So,
but
Mike,
we also know,
I was going to say that a popular talking point for Republicans was that we need to get rid of the Inflation Reduction Act. But if you dig into a lot of the details, a lot of the oil guys and natural gas guys like the Inflation Reduction Act and things like carbon capture credits, right? 45Q, new rules on the hydrogen tax credit, 45V were unveiled that people were pretty happy with because it had a broader swath of the energy that you could use to make hydrogen. Are you guys happy with those things right now?
I actually feel pretty good about our ability to defend the 45 tax credits. Q and V are the ones that are most important to us for carbon capture and hydrogen. We were pleased with the Biden administration rules, though we think they could be improved under President Trump on both CCS and hydrogen. So we'll work with the Trump administration to improve those. But there are provisions, I think, that under the Inflation Reduction Act that are vulnerable, particularly the funds from the Loan Program Office, which has just become a giant slush fund for favored industries under the Biden administration. So I do think the funds that haven't been obligated yet under the Loan Program Office are very vulnerable as Congress looks towards reconciliation. So that's where I think most of the focus will be.
But some of the money from the Department of Loan Office is going to like companies that produce, say, nuclear or have natural gas. Like it's not just like rando green technology. How are you going to distinguish that? Because if you need the loan in order to, say, restart a nuclear plant or work into small modular reactors, for example, what do you think about that?
Well, I think that's going to be something that Congress is going to have to sort out, and the administration is going to have to sort out. I'm pretty sure that at the beginning of the administration, what they're going to do is they're going to freeze all new funds coming from the Loan Program Office until they get a better sense as to what to leave in and what to leave out. And that'll be up to the new Energy Secretary, Chris Wright. I'm confident that they'll be able to figure out what they should focus on and the things that they need to leave behind. But that'll be up to the administration. Our focus is going to be on advancing a reconciliation bill that supports American energy. That means new leases in the offshore, new leases onshore, reopening Alaska, which President Biden has taken a particularly focus on in terms of cutting off the amount of oil and gas that we can produce in the state of Alaska. So we're confident that we're going to be able to prevail on the administration and the Congress to advance new leasing priorities as they get that big new reconciliation bill done.
Have you heard, what have been, I guess, maybe any rumblings coming out of this new Trump administration about how aggressive they plan to be as it relates to oil and gas?
I think they plan to be very aggressive. I mean, as you know, the president has really focused on how do we continue to grow this tremendous American resource. We're producing about 13.4 million barrels of oil every single day, which is a record. We're producing records amounts of natural gas, but we also see record demand for these products, not just record demand for oil and gas, but also record demand for coal and other sources as well. And that's because we're starting to see this the demand continue to increase. We're in a different era than we were during the first Trump administration, where energy demand was relatively stable during the first Trump administration. Everything's changed in the last 8 years, where you have new sources of demand growing. Data centers, of course, AI, more things being plugged into the electric grid. So I think what President Trump understands is that we're going to need a lot of energy going forward if we're going to win the energy security race.
Our thanks to Mike Sommers, API President and CEO. Coming up on the program, We'll break down some of the big staffing moves in the financial sector. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We turn next to the banking sector. Bloomberg Intelligence recently put out its 2025 outlook for global asset managers ahead of U.S. bank earnings next week. For more of BI's findings, co-host Alix Steele and I were joined by Alison Williams, Bloomberg Intelligence Senior Analyst, Global Banks and Asset Managers. We first asked Alison about some of the themes to watch out for when bank earnings begin.
The market's momentum is obviously the big story entering 2025. And the first quarter does tend to be the seasonally strongest quarter for the global investment banking business. We also do tend to get so good flows into the asset management business. So we think we're starting off the year with strength, also noting that the world's market capitalization hit a new high in mid-December. Since then, we've seen a little bit of a sell-off, in our global equity strategy team, led by Gina Martin-Adams, has actually flagged the fact that they are seeing some signs that are making them a little bit more bearish. But from an earnings perspective, keep in mind that we are the markets are so far above a year ago. We're going to see good year-over-year growth. The ETF flows are strong, bond flows are strong. So we're expecting to hear good things from the banks when they report next week. And as I said, really some good momentum entering the year.
Alison, I want to talk to you about asset management, the global asset managers, because the more I talk to this Balchunas guy, the more I kind of say, what's going to happen to all those great mutual fund companies that I grew up with as my clients, the Fidelities of the world, the Capitals of the world, the Alliances where you hung a shingle for a while. What is that business? What happens to that business?
So consolidation has been something that, as you know, for as long as we've been in the business, there's been huge calls for consolidation, because that really makes sense on paper, right? You have a business that you can scale. You have this intellectual capital that you can scale. And I think Eric Balchunas will always say, hey, Wellington and T. Rowe, why can't they get together? But as we also know, it's all about culture for these asset managers, and really culture and process is what makes active managers great, and really what they stick to. And so that's really what makes deals difficult. And also the fact that what you're buying really is, a culture and a process and people. And so even though deals look good on paper, it's a lot harder to do practically speaking. But we think that managers will continue to look to see for opportunities. Are there opportunities for fund consolidation? Are there opportunities within managers? So we do think that continues. We've also seen the traditional managers buying into the alternatives business. So active fund management has been under pressure. It is still the biggest business by assets worldwide. We just want to note that to Eric. But the alternatives business is where all the growth is. PE has been a phenomenal growth story for many, many years. Private credit really getting into it and seeing some faster growth.
So I'm going to go back to banks, but there's kind of a tie over, especially when it comes to private credit. If we have William Barr stepping aside, do we anticipate less capital requirements, less stringent Fed stress tests, and does that bring them into sort of the private credit markety world again?
Well, I would say that the banks have already been participating through partnerships, and one of the best examples that we always point to is what Goldman Sachs has been doing with their asset management business, right? So for a long time, Goldman Sachs has had this merchant banking expertise, and for many decades they were investing their own balance sheet. But within the last several years, what they've said is, look, we're going to use that expertise and we're going to manage clients' money. We're going to charge a fee. Investors like this. just because there's less direct balance sheet risk, there's more fees. That's a business that gains higher multiples. And so they've been expanding in the private credit space with that business. And I think banks are also doing it with different partnerships. And so the banks have been active on that front, and we do expect that business to continue to expand.
So, Alison, one of the Trump trade sectors that I hear all the time has been financials, because maybe the lighter deregulation, touch maybe lower taxes, all that kind of thing. And the stocks have reacted, generally speaking. How much of that trade is still left here? I'm looking over at trailing 12 months. A lot of the big names are up 30, 40%.
Yeah, so I think, we have seen the stocks move. Part of that is earnings driven. I talked about the capital markets momentum, and part of that is sentiment driven. And to Alix's point earlier, what we're seeing, the news with regard to Barr, I think, is really just reinforcing that Trump trade, reinforcing that expectation for less regulation. And so definitely the sentiment the sentiment driver, I think we saw the stocks gain 17% in a very short period of time, where earnings estimates move something like 3%. So that tells you that it really is the sentiment and the expectations that those earnings estimates can go even higher. I think where we're the most optimistic is the lesser antitrust scrutiny, which is going to add to M&A fees. We're very bullish on that part of the investment banking fee revenue recovery within BI. And with regard to the other regulations, so as I said, a lot of optimism has been baked in. But I think what we're going to focus on next week is really the core fundamental outlook. And I think to the extent that that can give investors some confidence, it can build into the story, because it is less regulation under Trump that I think is most exciting for some of these big banks. But also keep in mind the economic environment is better. The net interest income outlook is getting better. I already talked for a while about capital markets, but on the credit loss front, we've had 2 years of rising provisions. We're going to see that flatten out, and that's also helpful to the bank's earnings.
Our thanks to Alison Williams, Bloomberg Intelligence Senior Analyst, Global Banks and Asset Managers. We turn next to some big news in the financial space. This week, we heard JPMorgan Chase is planning to bring its staff back to the office 5 days a week, ending its hybrid work option. And separately, we were told the world's biggest hedge fund, Bridgewater Associates, dismissed 7% of its workforce. For more, co-host Alix Steele and I were joined by Michael Moore, Bloomberg Managing Editor for Finance in the Americas. We first asked him about JPMorgan Chase and whether going back to the office full-time is a surprise.
No, not really. I mean, the majority of their staff was already doing that, but this would be the rest of the staff. So we've seen some firms move in that direction. Others, have used the flexibility as a recruiting tool.
Citi has.
Yeah, Citi has stuck with 3 days a week for a good portion of its staff. So I think we will see a difference among the firms. Some of the European firms have used it as a recruiting tool. So, but, Jamie Dimon has been very vocal about his views that, people work better in the office together. It helps develop talent. So, I think it will be kind of, leader by leader kind of setting the agenda.
I don't know. I mean, the fact is, it does work from home, so that does work. But let's get people back, so we'll see how it goes. Bridgewater Associates, huge hedge fund, cutting staff. Is this just the normal culling of people, or something different going on here?
Yeah, it's an unusual one just for the reason that they are coming off their best year in many years for the flagship fund. I think the new CEO is definitely trying to shake things up a little bit. He has replaced some of the top management. They've brought some people from the outside, which they hadn't historically done under Ray Dalio. So I think this, the stated goal here is there are some areas where they want to hire. They don't want headcount to get too crazy. This kind of brings them back to where they were, a little over a year ago in terms of headcount, and allows them to kind of be a little more selective.
Did they overhire or something, or did they just want to just move focus or something like that?
Yeah, I think, you have seen them, announce some efforts on the AI front. They may want to do some more hiring there. But we have seen some of the hedge funds more broadly do some overhiring. There has been a talent war. So this could be a bit of a correction there.
It's a unique place to work, isn't it? What's I've heard that. What makes it unique at Bridgewater?
Well, they have this, they've long had this culture of radical transparency, of being very blunt with each other. A lot of the senior people have been there since they were in their early 20s, have grown up there, haven't worked elsewhere. So there is a bit of an insular culture there. I think Nir Bardea, came in a little bit later in his career, so brings a different perspective than Dalio, who built this place, around his principles. So I think you could see a bit of a relaxing of that culture while still, being kind of a unique beast out in Connecticut.
JPMorgan, the latest bank to quit the climate finance group. This follows Citi, follows B of A. How are we understanding it? Is this like a complete backlash against climate and DEI, for example? Or is this just sort of like we're going to move to the middle, or are we just rebranding it?
I think it's a bit of rebranding. I think they were getting a lot of heat from some politicians over some of these pledges. They wanted something with
and these are pledges like we're not going to lend money to oil and gas kind of thing?
That's how they were perceived. They weren't always written that way, but that's how they were perceived. That they got the CEOs when they were in front of Congress a little over a year ago. J.D. Vance made a big point on this. So I think they thought we can do this in ways of lending to renewable energy without taking such a public stance that will get us a lot of political backlash. So I think you'll still see efforts on this, but they won't be as grand as this climate pledge that they had all signed up to.
What is this? I mean, the timing is not a coincidence, I'm assuming, given the new administration coming in. Is that how it's being read, or are they saying anything about that, the timing?
I don't think it's a coincidence. Right. I think the political winds have shifted on this. And in general, I think there is, these pledges always kind of came with an understanding of, okay, we need to help our oil and gas clients transition to this new world, so it's not going to be, cutting ties with the big oil companies. But I think they're being more cautious in that.
And it's not just, banks. We should point out McDonald's today, the piece coming out saying that it's walking back its DEI goals, saying it's changing its approach to diversity, equity, inclusion, no longer setting, quote, aspirational representation goals, instead focusing on embedding inclusion practices into its daily business. I don't know what that difference is, but that's why I wonder if it's just to rebrand. Like, now you don't want to say ESG, but if you still have some sort of like net zero goals, maybe that terminology is more okay. It's just sort of a branding and moving away from something extreme.
Yeah, I think it's not wanting to be seen as taking a political stance, more taking this is good for our risk perspective.
Our thanks to Michael Moore, Bloomberg Managing Editor for Finance in the Americas.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.